Picture this: you lend your friend $150 million. They tell you it's totally safe, no worries. Then, literally overnight, that entire amount disappears. Well, that's exactly what just happened to BlackRock, the world's largest money manager controlling over $10 trillion in assets. And here's the terrifying part: if it happened to them, it could happen to your retirement account, your savings, your investments. Let me break down what happened in the simplest terms possible. Back in October 2025, BlackRock made a $150 million loan to a company called Renovate Home Partners. Think of them as a big home improvement company, the kind that helps people remodel kitchens and bathrooms. BlackRock looked at this loan and said, "This is perfect, worth every penny, 100% safe." Fast forward to December 2025, just 2 months later, Renovate suddenly filed for bankruptcy. Chapter 11. Done. Finished. And that $150 million loan, completely worthless. Imagine lending someone $150,000 for a house, and overnight being told, "Sorry, that house is actually worth $0 now." Now, you might be thinking, okay, that's bad for BlackRock, but I don't have money with them, so why should I care? Here's why this isn't an isolated incident. This is like seeing one cockroach in your kitchen. If you see one, there are hundreds hiding in the walls, and those cockroaches are hiding inside your mutual funds, your ETFs, your pension plans, and even your bank's balance sheet. Let me paint you a picture of how big this problem really is. Right now, there's $1.7 trillion. That's trillion with a T sitting in what's called private credit. Think of private credit as loans that don't trade publicly like stocks or bonds. They're hidden away in the financial system like locked boxes. Nobody really knows what's inside until the box breaks open. That $1.7 trillion is spread across your retirement, mutual funds, ETF investments that promise steady returns, pension plans that millions of Americans depend on, bank balance sheets that hold your deposits. Here's the scary part: when one of these loans goes bad, there's no warning bell, no gradual decline. It goes from everything's fine to it's all gone in literally one day. It's like building a house on what looks like solid ground, only to discover you're actually on a sinkhole. Everything looks stable until the moment it all collapses. So why is this happening right now, in early 2026? Let me explain with a simple story. Imagine you own a restaurant. For years, customers packed your place every night. You borrowed money to expand, add new locations, hire more staff. The bank loved you because business was booming. Then, slowly, customers start coming less frequently. Maybe it's the economy. Maybe people are cooking at home more. Maybe it's competition. At first, you think it's temporary. You keep all your staff. You keep paying rent on those extra locations. You keep making payments on those loans. But here's the problem. Your expenses haven't changed, but your income is dropping every month. Eventually, you can't keep up. You try to hang on as long as possible, but one day, you just can't pay anymore. Bankruptcy. This is exactly what's happening across the American economy right now. Remember Renovate Home Partners? They went under because the housing market has been slowing down dramatically. People aren't spending money on home improvements like they used to. Why? Because they're worried about their jobs, worried about the economy, worried about the future. And it's not just home improvement companies. Let me show you what's happening across multiple industries. Think of the economy like a massive line of dominoes. When one falls, it doesn't just stop there. The first domino is the housing sector. The housing market is absolutely flooded right now. It's early 2026, and we're heading into what's historically the slowest time for home sales. But this year is different. We've got too many homes for sale and not enough buyers. Why? Because mortgage rates have been elevated, people are uncertain about their jobs, and many are choosing to save money instead of spend it. When people don't buy homes, they don't renovate them. Companies like Renovate collapse. The loans backing those companies, they evaporate. Domino number 2, the auto industry. Here's something that should terrify you. In November 2025, China's car sales dropped for the first time in over a year. But China isn't unique. This is a global problem. Car dealerships everywhere are sitting on massive inventory. Brand new cars sitting in lots, not moving. It's like having a store full of fresh bread, but every day it gets staler and staler until nobody wants it at any price. These car manufacturers borrowed billions betting on endless growth. They built factories, hired workers, stocked dealerships. Now, showrooms are empty. Workers are getting laid off. And those loans the companies took out, they're starting to look very, very shaky. Domino number 3, small businesses getting crushed. This one hits close to home for millions of Americans. Small businesses, your local retailers, restaurants, service providers are facing a perfect storm. Many of them borrow money to buy inventory, especially products they import from overseas. With all the tariff uncertainty throughout 2025 and into 2026, these businesses have been getting hammered. Here's how bad it is. Some of these small businesses are paying interest rates of 30% on short-term loans, and they have to make payments every single week. Imagine borrowing $100,000 for your business, paying $30,000 in interest every year, and making payments every Friday. If you don't sell your products fast enough, you're done. There's no cushion, no margin for error. And here's the kicker: as of December 2025, import volumes are projected to drop nearly 18% compared to previous months. That's the biggest drop we've seen since early 2023. Less imports mean less business for these companies. Less business means they can't make their loan payments. Can't make payments? Bankruptcy. And those loans? Zero value. Just like BlackRock's $150 million. Now, let me show you what's happening behind closed doors at banks. Banks have internal data that tracks something called delinquency rates. Think of this as the percentage of people who are late on their loan payments. It's like a fever thermometer for the economy. When it starts rising, you know something bad is coming. As of late 2025 going into early 2026, delinquency rates on consumer loans have been creeping up, and here's what banks do when they see this. They panic. It's like if you're a lifeguard and you see storm clouds forming. You don't wait for lightning to strike. You get everyone out of the water immediately. Banks are doing the same thing. They're tightening lending standards across the board. That means harder to get a business loan, harder to get a car loan, harder to expand your company, harder to refinance existing debt. When banks tighten up like this, it creates a vicious cycle. Businesses that were barely hanging on suddenly can't get the credit they need to survive. More bankruptcies, more loans going to zero, more BlackRock situations. Here's something most people don't understand, but it's absolutely critical. All across America right now, early 2026, businesses are sitting on mountains of inventory they can't sell. We're talking about retailers loaded with products for the holiday season that didn't sell, warehouses packed with goods, car dealerships with unsold vehicles, manufacturers with finished products nobody's buying. Now, here's the problem. That inventory was purchased with borrowed money. Let me give you an example. A small clothing retailer borrows $500,000 to stock up for the holidays. They bring in shipments from overseas, pay tariffs on those goods, pay to store them, pay employees to sell them. They're banking on selling everything by February 2026 to pay back the loan. But what if people don't buy? What if holiday sales are weak because consumers are worried about the economy? Suddenly, that retailer is stuck with a loan they can't pay back. Inventory that's losing value every day. Winter coats aren't worth much in February. Pressure to discount prices just to move products. And this is happening everywhere. As of late January 2026, retailers are offering discounts averaging over 20%, nearly the highest we've seen since mid-2025. That's desperation. They're essentially saying, please, just take this stuff off our hands. But here's the real problem. That inventory was used as collateral for loans. Banks and lenders said, sure, we'll lend you money because you have all this valuable inventory. Except now that inventory isn't valuable anymore. It's like using your car as collateral for a loan, then discovering your car is actually worth half what you thought. The lender is going to come knocking. Remember how I started this video talking about BlackRock's $150 million that vanished overnight? Now you understand why this isn't just one isolated incident. This is a symptom of a much larger disease spreading through the economy. Companies across every sector, housing, automotive, retail, manufacturing, borrowed money betting on growth that isn't coming. As of early 2026, we're seeing consumer confidence dropping as people worry about jobs, unemployment starting to tick upward as companies lay off workers, import volumes falling as uncertainty dominates, businesses desperately discounting products to raise cash, banks tightening credit standards as they see trouble ahead. It's all connected. When consumers worry about their jobs, they spend less. When they spend less, businesses make less money. When businesses make less money, they can't pay their loans. When loans don't get paid, they go to zero value. When loans go to zero, the banks and investment firms holding those loans take massive losses. And who holds those loans? The same funds that hold your retirement money, your investments, your savings. Here's one more critical piece of data that shows where we're headed. There's something called capacity utilization. Basically, what percentage of our factories and production facilities are actually being used. As of early 2026, this number has been declining. Think about it this way. If you own a factory with 100 workers and 10 production lines, but you're only using 7 of those production lines because demand is down, what do? You lay off 30 workers. This is happening across America right now. As capacity utilization drops, unemployment rises. It's almost a perfect mirror relationship. Less production needed equals fewer workers needed. And here's the scary projection. If current trends continue into late 2026, we could see significant job losses across manufacturing, transportation, and retail sectors. Some analysts are predicting this could be one of the worst periods for employment since the pandemic recovery. More unemployment means more loan defaults. More defaults means more situations, like BlackRock's Renovate disaster. Now, I know what you're thinking. This all sounds terrible, but what am I supposed to do about it? Here's the honest truth. You need to look at where your money is right now. If you have investments in corporate bond funds, private credit ETFs, high-yield bond mutual funds, funds that focus on small and mid-sized companies, you need to understand what you're actually invested in. Many people have no idea that their safe, steady income fund is actually loaded with loans to companies that could go bankrupt overnight, just like Renovate did. It's like thinking you're storing your money in a fireproof safe, only to discover the safe is actually made of cardboard. I'm not saying sell everything tomorrow, but I am saying you need to know what you own. Look at your statements, understand your exposure, ask questions. Here's what keeps me up at night as we move through 2026. 2026. When banks get scared, and they're getting scared right now, they don't just reduce lending a little bit, they can effectively shut off the credit spigot completely. It's called a credit freeze. Imagine if tomorrow, businesses suddenly couldn't get loans to make payroll, buy inventory, expand operations, refinance existing debt. The economy would grind to a halt, and we're seeing early signs of this happening right now. Banks are reporting that they're tightening lending standards at rates we haven't seen since the 28 financial crisis. So let me bring this all home. What happened to BlackRock with that $150 million loan isn't a one-time fluke. It's a preview of what's coming. As we move through 2026, we're likely to see more corporate bankruptcies across multiple sectors, more loans going from perfectly safe to completely worthless overnight, more pressure on the financial system, more uncertainty for anyone with money invested in the markets. The dominoes are already falling. Housing companies are struggling. Auto manufacturers are struggling. Retailers are struggling. Small businesses are struggling. And all of them have loans that could evaporate just like BlackRock's did. Your job is to pay attention. Don't assume your investments are safe just because someone told you they were. Remember, BlackRock said their loan was 100% safe, literally 1 month before it went to zero. Look at your portfolio, understand what you own, know your risk, and consider whether now might be the time to reduce exposure to risky credit investments before the exits get crowded. Because here's the final truth: when panic hits financial markets, everybody rushes for the door at once. And if you wait until then, you might find the door is locked. The warning signs are flashing. The question is, are you paying attention?